Oh, good. Okay, so this is the investment clock. So you'll see this slide a few times. So basically the idea is that we move through cycles. And as we move through these cycles, we go through an initial shock. Companies respond. And these are the ways they respond: cost cutting, liquidations, dividend cuts, and things like that. And then we turn the clock. And that sort of defines, is this a buying scenario or is it a selling scenario, or are we just looking? Okay, so we're going to focus in on gold just because it's the biggest sector right now by revenue. So that's the cycle I'm looking at with respect to the clock. So the initial shock, everyone's probably familiar with it. We had this capitulation back down here in the early 2000s. We had the commodity supercycle, got the gold price up to over $1,900. Went right through the global financial crisis. And then we had the hangover of the supercycle. You know, we had $17 billion of write-downs, $164 billion in lost value. And then since that drop to the end of about 15, we've been seeing higher lows in the gold price. But it's been relatively range-bound until recently. So if you look at this McKinsey graph, you can look at the same thing from 2011 to 2018 and basically look at the $129 billion of enterprise value that was lost by major gold companies over that period. If you look at, with respect to the equity issued, net debt raised, dividends paid, that basically it looks like the equity they issued and the debt they raised just paid their dividends. And the biggest deal was basically the commodity prices. They built up their companies for higher commodity prices, and when the commodity prices dropped, they didn't know how to react. But they did react. And so the next few slides will be just about one company's reaction, because there's no point in doing everybody, but Barrick was a really good example of what happened. So we can see the drop in costs. So you got cost of sales, you got G&A, and exploration. You know, the biggest drop there was the cost of sales. A 25% drop, and basically now we're sitting flat. All-in sustaining costs a little bit more complicated because you got to introduce sustaining capital into it. But again, 25 to 30% drop in your AISC. But we've been seeing some creep since 2016. The most important thing is what they needed to do was get to free cash flow positive, because they couldn't count on the markets anymore to fund them. So they actually had to be a real company and actually make money. So since that part in 2011, they basically reduced capital. They've lowered their operating cash flow by generating less ounces, but actually you see the gray bars, they're actually generating positive free cash flow. And that was the reaction, and everything is driven to get them there. And so in terms of other things they did to lower their debt was company liquidations. So you saw $4 billion in divestments over that period. And now, right now, given another topic, which is the mega mergers, we're going to see more divestments to pay for the debt that they have already acquired, and in Newmont's case, the debt that Goldcorp gave them. And so now the other part of the puzzle, dividend cuts, asset write-downs, we talked about. So dividend payments, almost 80% drop in dividend payments. Now the most important thing for them going forward in terms of competing with gold ETF equities, equity ETFs, is to maintain stable dividends. That is the most important thing, because that is the differentiation factor from them and the ETFs. The ETFs offer solvency, they give you liquidity, they give you anonymity, trading flexibility. And if you want to distinguish yourself, that's part of the reason to do the mega merger, is to be a bigger fish. Okay, so you can see the drop in the debt. So you basically halved your debt from over 12 billion to under 6 billion, and it keeps going. And the other thing is all those write-downs, the Pascua Lama and numerous others, $25 to $30 billion in write-downs. I mean, this is a proxy for the entire industry. This is just Barrick, but it gives you a hint what's happening everywhere else. And so this is Newmont. So when you look at Newmont, you can see what they're doing. Divesting. They sell Midas. They sell Jundee. They sell their portion of the Penmont JV with Peñoles. They're reducing debt. They sell Waihi. They sell their stake in Batuijao. All debt reduction, debt reduction. And now, dividend raise. And the most important thing is stable dividends. That's going to be the discussion going forward of what you're offering as a gold company. It was all about growth before, and so the money was always spent on growth. It was never spent, dividends was just something that happened, but now it's a much more important piece of the puzzle. And then now, after all that, now we have potentially a stabilization of metal prices. So a lot of what's happened now and all the interest is that 20% increase in gold price from about $1,300 to almost $1,550, and now I believe it's around $1,480, $1,490. That in itself has generated a lot of interest. And so why is it interesting? You guys know as well as I do, we're sitting on about $16 trillion of negative yielding debt. Gold has no yield, but it's better than negative. And in an environment of low real rates, gold does quite well. Okay, and then we have all this tariff uncertainty. I'm not going to go through this because this changes every day. But right now, this is potentially going to impact this. So this is the 75% of the global economies. Their average growth rate in Q2 was just over 1%. The biggest economies that were over that 1% were China and the US. And when you threaten the growth of those two, you threaten the growth of the entire globe. So then you're dealing with potential lower growth rates, negative yielding debt, and now you have a lot more interest from the generalists. And so where do they go? They're going into gold. And so you see the next positions up at highs right now. That's a risk if we fall back. But the other thing is the gold ETF inflows. It used to be just Europe, but now the North Americans have come back. And right now, according to the World Gold Council, the holdings in these ETFs are the highest they've ever been. And the last time they were even close to this, gold was trading at 1,700. Okay, but with all that, gold still is not the best performer. Okay, so let's talk about the recapitalization of the industry. And it's not really the industry, it's really the juniors industry. But the recapitalization, so if you look back at 2009, you know, they raised over $14 billion, you know, 128 transactions. They did 150 transactions in 2010. But in 2018, there was, you know, less than $2 billion worth of transactions, you know. So it was a big drop from 2009 back down to 2018 in terms of that flow of money to capitalize the industry. And so who was trying to play the gap, stopgap for smaller companies was producers. So producers in that decline in costs, one of the things they declined was exploration. And so that translated was basically just giving the money to the explorers to let them explore and taking 10% equity stakes or 9.9 equity stakes in them and funding them, or doing joint ventures, project specific. For juniors, it was great because there was no market. There was no retail market. They could get a premium, and the company wasn't interested in issuing warrants. And so the other part of the puzzle, especially for Canada, is the weed market, so the cannabis sector, which has taken a lot of the speculative money out of the mining industry. And so, I mean, the mining industry wasn't going very well anyway with respect to commodity prices. So you can see that the GDX is there in orange, the gold price there, index is in yellow, and the blue is the cannabis. So basically the cannabis has been trailing down since March, but the gold and the GDX, the equities and the gold price have been trading up since the end of May. And so that has changed in terms of the speculative interest, especially in the Canadian markets. That's not a problem in the Australian markets. So then we suddenly see $1.4 billion of financing. Okay, they're not big financings. They're not the 220 million US equity placement that an institution did in Agnico back in the first quarter of 2017. We're not seeing those big ones. The big ones that we did see, like the 150 million into New Gold, that was theoretically a bought deal. The last 50 was very hard to sell. We're not seeing a lot of the big ticket ones being done. We see a lot of the 11 to less million done, and the biggest person in this is Eric Sprott. Okay, but still, if we look at the TSX Venture as a proxy for the resource sector in Canada, I mean, still, total financings year-to-date in September versus year-to-date last year are still down 43%. So it looks good, but it's really not as good as it was still. So then the other part of the clock is, okay, if the markets start to be interested, with a caveat, mostly retail, is the industry interested? Do they see a turn in the cycle? So what we saw was the mega mergers. And so this is a graphic of the market cap of the major Canadian listed, US, North American listed companies in North America. So this was pre-mega merger. Okay, so if you think about relevance, you think about the generalists. They prefer passive funds. They want liquidity, anonymity, trading flexibility. And so in an attempt to stay relevant, what these guys did was they needed to be bigger. And you say, why? Well, the 26 listed companies here, cumulatively, the market cap at that point before the mega mergers was only $100 billion. Only $100 billion. $20 billion less than BHP. Apple lost $450 billion in 3 months. So if we think that we're big, we're really not. And those individual companies have to make themselves all the bigger. And so we saw a lot of this. And now also, to fill a gap, we see a lot more private equity. And the private equity funds, most people know them, Orion Mine Financing, Blackstone, Tactical, RCF. I mean, they were helping, in terms of being a 7-Eleven, but it's not cheap. Pretium's $350 million credit facility with those guys was about 15%, although the Analyst discount at 5%. Okay, the benefits of these guys, their due diligence is quicker than a bank, but what they do is various types. So they'll take it in equity, they'll take it with debt, they'll do a convert with you, they'll do a stream, and they'll even do an offtake. They'll do a cumulative financing such that if they're not making money in one, they're making money in the other, but guaranteed they'll make at least 15%. So cash takeover. So this is suggesting we're already booming if we're getting that. So what have we been getting? We get $4.4 billion in purchases by Australian gold producers, which were cash. But the reason they were cash is these were ASX-listed companies, and the TSX-listed company wouldn't take their paper. So most of them actually issued equity at home to pay for this. So it looks good, and it is good, but the Australians, as I'll show you, were making money. Because the Australian gold price, while we were sitting at whatever, $1,250, $1,300 US, the Canadian dollar wasn't falling as fast as the ASX. And so it was a perfect storm for them because they had all this trading issues, China growth, all that, which would have hurt iron ore, would have hurt copper, would have hurt a lot of metals, but didn't hurt gold because it weakened the Australian dollar. And so their gold price was going up to $2,200, and they made a lot of money. And so Newcrest, accumulated about $3.5 billion of cash. And with that cash, they bought Red Chris. With that cash, they bought assets in Ecuador. So these guys were always all about Australasia, that we're the biggest people in Australasia. But the problems in countries like Indonesia, in other parts of Asia, they're finding it hard to grow there. And they're finding a lot of things in Australia very expensive. And so coming over to North America and even South America made a lot of sense. Okay, so I'm already at summary, so you can get to your drink quick. So you can see there's a lot of various indicators of the investment clock that have already ticked over. You had the post-shock, you had the cost-cutting, dividends, write-downs, divestment, you have gold potentially stabilizing. The recapitalization asterisk is it's mostly junior, mostly retail, not institutional equity. Mega mergers versus them actually taking you out, they're taking each other out. And producers funding juniors because they're not doing a lot of exploration, specifically in the gold sector, not in copper and not in some other metals. Cash bids by Australians. So in form of the cash bids would suggest we are there. But since there's another asterisk there that the Australians have been making money over the last 4 years, have got the cash, but 2, they can only use cash. Okay, so it's not over yet. So one of the big things is why the institutional equity is not here is because in 2011, the assets under management in North America, mostly in the States, was about $54 billion. 93% of that was active. So these are people that would do your private placements. They would be active in the market. Stock pickers. Okay, so fast forward to 2018-ish, that number went down to the total assets under management went to 30. So it's gone from 90. So the pie has shrunk to a third. But importantly, that 90 billion, that 50 billion that they had, the 50 of the 54 was active, is now 30 billion. So they've got a smaller slice of a smaller pie. Okay, again, I talked about what generalists prefer these ETFs to actually betting on companies. But there's still a gap. So year to date, we've seen them, and I've shown you the graph of the gold ETFs, and they're buying that like crazy. But we've had net outflows in the GDX. So even though they prefer this to buying individual companies, we're still seeing outflows, that they're still more keen on the commodity than they are in the equity. And for majors, the big issue is trying to show that they're actually making money at these kind of prices and they can keep issuing stable dividends. Okay, but on the positive side, the Precious Metals Summit, which is basically the introduction of institutional equity to more of the junior sector than the gold show, the big increase there was institutional equity investors in terms of actually going. So they are looking now. So if there was ever a moment to buy this, this potentially could be it. So again, various indicators of the clock that we are at a buying moment. The recapitalization was mostly the juniors. Larger financings, not really apparent. And I don't think that the institutional equity investors are interested in those. They'd rather just buy on the market and get those dividends and be exposed to gold. So again, more gold ETFs inflows, but outflows of equity ETFs, suggesting there might still be an opportunity. Okay, I'm 10 minutes quicker than I thought, so you can get to your drink quicker. All right, thank you very much.